Hey there, I've realized that I've been talking about theta in a lot of my videos without ever explaining what theta is. So this video is all about theta. After you're done watching this video, you'll know exactly what theta is and how to use it to skyrocket your returns with options trading. I've been making a full-time income with options trading for quite a few years. So if you want to do the same, then you just need to understand theta and how to use it. So let's dive in. All right. So theta is one of the Greeks in options trading. There are several of them. I want to say there's like 6 or 7. Theta, delta, gamma, rho. So some of these are more important than others, depending on the trade that you're doing. But theta is really important to every options trade that you could do. So it's one of the ones that I tend to focus on and really look for when I'm picking an options contract. So basically what theta is if you want to think of theta, just think of theta as time. Theta, time, it's like T's. I think of theta as time, time is theta. So it measures how much the value of an option contract decreases in value as time goes on. Okay, so when you set up a call to sell it or a put to sell it, a lot of that math on how valuable that call or put is because of the time that is calculated to be a part of that contract, and that time is called theta. Okay, so every day that passes, if the underlying stock doesn't move, the option contract that you bought is losing its value. And this time decay isn't random. It's built into the pricing of every single options contract. So when you go and you pick your contract on something like Robinhood or something like that, you can look up what the theta is, and it will give you a little number. And that number is the amount of cents per dollar that you're going to lose every day that you hold that contract. Okay, that doesn't mean that your contract is going to lose value overall. There are other factors that influence your options contract, like movement in the stock price, but you need to understand theta. Okay, so if you buy an option today and hold it for a week without any movement in the stock, it's highly likely that the option will be worth less just because time passed. So essentially, theta is a measure of the days in that contract, and every day that passes, theta is draining time value out of that contract. Okay, why you should care about this. So if you're buying options, theta can be your enemy because you've bought something that if the stock price remains the same, it's going to decline in value. If you're selling options, theta is like your best friend because you want time to drain out of that contract because you sold it. So every day that goes away is another day you're putting money in your pocket. Theta decay is guaranteed, okay? And it benefits the seller every single day the option doesn't get exercised, okay? So it's guaranteed the time's gonna pass, just like it's guaranteed the sun's gonna rise, okay? Okay, so let's think of an analogy here. So theta is like a melting ice cube. When you buy an options contract, you're holding an ice cube and it has size, weight, and value, but it's melting. And it melts kind of slowly at first. So that is interesting as well about theta. And then it gets faster, it declines faster the closer you get to expiration. Okay, so you'll see this a lot when you're holding like a 2-week option and it has like a lot of theta value at the beginning. And then a last day or two, if the stock price isn't near the strike price, it just drains really fast. Like the value of the option goes away really fast, okay? That's the time value you're losing every single day, and it speeds up towards the end, okay? The opposite is the case when you sell an options contract. You profit from when the ice cube melts, okay? So it's sort of like if you sold the contract, you're watching that ice cube in the buyer's hand, and you're like, hey, if that strike price isn't met by the expiration date, then you've got to keep holding that ice cube and it's going to turn into nothing, and therefore you can't sell nothing back to me. Makes sense? All right. So that's kind of awesome. So how do you use theta to rocket your results? Okay. Sell options and don't buy them. Okay. This is the thing that's easiest for when you start options. You probably don't want to be on the buying end because it has far more risk because you're buying theta. And theta is 100% guaranteed to happen. But if you're selling theta, that theta is also 100% guaranteed to happen. So you can use that to your advantage. To increase your returns using theta, you want to be an option seller, not a buyer. This means you're the one writing the contract and collecting premium upfront. So the two examples here are selling a cash secured put or selling a covered call contract. Options are decaying assets when all other factors remain the same. And every day that passes without a major movement in the stock price makes the option lose value. And that's a prefer for you, the seller. So you want to start with things like covered calls or cash secured puts, where you'll sell contracts on stocks you already own or that you want to own. This is really important. You guys use my stock buying methodology. Don't just sell covered calls and cash secured puts on any old stock. You'll get burned. Make sure that stock is a quality stock so that theta decay can work in your favor. Okay. You also want to choose the right expiration date. The rate of theta decay accelerates closer to the expiration date. This is where most of the time value disappears and fast. So if you're a seller, this works in your favor and you can collect high premiums with the benefit of fast decay. This is why a lot of people prefer 1 week out, like go towards 1 week options, because the theta is sort of, there's a lot there on Monday, Tuesday, Wednesday if they sell on a Monday. But then if the stock price doesn't move, it drains out really quickly. On Thursday and Friday, there's hardly anything left and they can just close that contract out for like pennies on the dollar. So that is one reason why people choose weeklies. I don't gravitate towards weeklies. I gravitate towards 3-week contracts just because the same thing occurs and I can usually get a lot of that theta decline out of the contract after about a week and a half or 2 weeks. So same concept, different time frames. Okay, you also want to pick stocks that are stable or slightly bullish for this strategy. I'm not saying like overall for every options sort of play that you want to do, but if you are just making a theta play, you want to make sure that you're picking stocks that are stable or slightly bullish. Theta strategies like selling covered calls or cash secured puts work best when the stock doesn't move too aggressively, okay? Extreme movement can trigger assignment or big losses, like on the cash secured put side, but steady sideways or slow upward movement makes it more likely that your options will expire worthless and you keep the premium, or that you'll get called away on a covered call and collect some cap gains at the same time. That's also a big win. So you want to pick high quality, low volatility stocks that move within a predictable range. Okay, so like for me, I like Apple, Costco, JP Morgan Chase, Amazon for this because they're fairly predictable. They don't make these huge moves up and down. All right, so that's important. You also want to be consistent and think in systems. So theta isn't about one big win. It's not. Like you're not going to get like usually 1,000% gain out of making a theta-based options contract, okay? It's just about stacking small wins repeatedly over time. A lot of people think about these theta wins as being like an extra dividend that their stock is paying them. It's a higher rate than what a dividend is, which is great, but it's just an extra way to collect cash from a stock asset that you own, which is beautiful. So the real magic of theta trading is in consistency and in compounding. So when you collect $100 on like an Amazon contract or $500 on a Costco contract, it may not sound exciting at first, but it adds up to thousands per month and can scale your account dramatically over time. Dramatically. This is one of the ways that I beat SPY every year in my 401k is because I just do sell covered calls and I use theta to my advantage and it creates a lot of income coming into my account. Okay, so here are some action steps if you want to move forward with using theta or any other option strategy I can help you with. If you want my help trading, there's a link in the description to book a call with me to learn more about how I can help you out. Or if you want to see how my client Ansel is also making a lot of money off of theta and other options trading strategies, he is now making $14K a month off of a $250K portfolio. And you can hear about that by clicking the link in the second link in the description. All right, guys, catch you later.